In this week's video, we'll review the latest charts and data to help us answer the question, will renewed tensions with China bring the bull market to a painful end? Friday's stock market session got off to a reasonably good start until mid-morning when this news crossed the wires. When the headlines are scary and markets are extremely volatile, it's always good to shift back to a mindset of beginning with the end in mind. What are we trying to accomplish? From a shorter term perspective, what we're trying to accomplish is to stay with this trend that began down here when the tariff news became less bad. It's probably fair to say that the tariff news became increasingly worse today, something that we need to respect. Thus far, as of the close on Friday, we haven't violated any of these reference points that we've covered in previous videos, including these two dotted lines here, which are reasonable retracement levels based on the signals that we covered in the September 19th video and the September 12th video. And even though those videos contained a lot of tables with a lot of green, we also covered, when things were going well, that the drawdowns, even in those bullish scenarios, were fairly significant. You can see there's a clustering in this region here. So let's assume, hypothetically, that market backtracks from the closing high this week to 6,300, roughly where these two dotted lines are, and those are tied to those maximum drawdowns from the signal dates that we covered in those two weekly videos earlier this year. Thus, if the S&P 500 were to backtrack in this region here, let's say to 6,300, that would represent a drop from this close of 6.9%. And we know that too would fall into the 100% normal and to be expected range within the context of an existing and ongoing secular bull market. These reference points can help us assess emerging bearish probabilities as well. So for all of this to be useful, we have to trade the chart in front of us, stay disciplined, and remain flexible as the situation evolves. Has anything else happened recently that might help us remain patient during a period of high volatility or during a correction and/or pullback? The answer is yes from Carson Research. When the S&P 500 makes new highs in August, September, and October, average return in Q4, 6.8%. The median return, 7.2%. Every single historical case, the market was higher in Q4. Upper right-hand corner of your screen from Nautilus Research. The NASDAQ just did something that it's only done a handful of times historically, dating back to the 1970s. As far as the S&P 500 goes, walking forward from these signal dates, similar to what just happened on October 6, 2025, if you were patient, historically in every single case, the S&P 500 was higher a year later. The number's out here. The average gain 1 year later, over 15%. This, something that just happened, and this, something that just happened, align with all of this that we covered on September 12th and again in a different form on September 19th. The VIX did have a big move on Friday, but we have to remember this was the range during the day. This chart's as of 2:23 p.m. Eastern Time. Similar range right in here. And look what the S&P 500 was doing in 2013. Similar range here. Look what the S&P 500 did in 2019. And we've been in that window recently, and the market performed well. If we were to look at the moving averages in isolation at 2:55 p.m. on Friday, October 10th, you can see we really don't have a lot of damage to the trend profile at this point. If this look up here starts to evolve into something more like this, concerns would increase, or something more like this, concerns would increase. Notice, you get a similar evolving look in here during a 100% normal and to be expected correction. And in this case, the market went on to make new highs. But you can see as the longer term moving averages tightened up here and turned up, we did have approximately a 10% correction here that ended in October of 2023. So it wouldn't be abnormal here to see some type of pullback. But at this point, we really have little to no damage to this trend. And we did close below the 20-day moving average in blue, but we've done that a handful of times in here. And as you can see, the 20-day moving average is way too fast relative to our long-term time frame. And remember, we have to think about this volatility within the context of what we're trying to accomplish. And what we're trying to accomplish is we're trying to navigate between a point A and a point B that could be several years down the road in the context of 100% normal and to be expected volatility. It would be great if the market could go up every day. We all know it doesn't work that way. We don't want to make any assumptions about what's going to happen over the next 6 months, but at the same time, we don't want excessive fear relative to normal drawdowns to derail us from our primary goal. If we want to feel good in the context of a bull market in 1 year, 2 years, and 3 years, it's extremely important that we're not continually worried about volatility. A good portion of this week's video was recorded using charts as of the close on Thursday. This chart, as of 3 p.m. on Friday, October 10th, meaning it was after the news hit the wire on Friday, the negative news. Well, VUG relative to VU was still up 0.32% for the week, and the analysis that follows was not impacted in any way. This is still a bullish breakout that's holding above these levels here. And everything that we say later in the video about this chart still applies. And that's true for most of the charts that we've covered. And conceptually, it's important to understand what the market looked like before the negative news came to light. And that's exactly why it's still helpful to review the charts as of Thursday's close. We'll cover this chart as of Thursday's close, and you can double back here. You can see the chart really didn't change because it's tied to a weekly time frame, and many of the charts that we're covering are tied to monthly time frames. VUG, the ETF here, has a heavy weight to technology. Left side of your screen, it's from our buddy Dean. Something that just happened. Similar price momentum regime suggests short-term chop, consolidation, volatility, followed by higher prices. The tech sector outperformed the S&P in 6 out of the 8 timeframes over the next year. Once again, something that just happened aligns with the message from this chart that we'll cover using numerous charts in the remainder of the video. It's also important to keep in mind, just as this headline crossed the wire and significantly impacted the market in the short run, it's also possible that a post on social media can do the same, but in the other direction. We have a lot of press conference risk here, which is our way of saying things can reverse in a positive manner just as quickly as they did in a negative manner. We don't want to assume what happens next. Thus, we'll stay with the trend as long as it's intact. Just finished reading a book about the psychology of being in the major leagues, Major League Baseball. The takeaway was fairly simple. If you're pitching, take it pitch by pitch. If you're at the plate, take it pitch by pitch. We'll open the Friday, October 10th, 2025 video with the chart that we covered in the April 25th video earlier this year. The orange and blue lines are anchored volume weighted average price lines. The orange line is tied to the January 2022 peak prior to the 2022 bear market. The blue anchored volume weighted average price line is tied to the October 2022 low. And in that April 25th video, we said the market made a stand near a very logical area. Intraday, it literally bottomed in between the orange and the blue line. And based on the S&P 500's daily closing high that was made earlier this week, if we attach an anchored volume weighted average price line to this point here on the chart of the S&P 500, And we do the same for the low here, so that would be the light blue line and the red line. Hypothetically, out of this formation here, if we saw something similar, that would represent a drop of approximately 11% coming back to the light blue line from the closing high earlier this week. And we know if the market were to drop 10.9% from the closing high earlier this week, that would fall into the 100% normal and to be expected range of pullbacks within the context of a secular bull market. And that's relevant because in the context of a secular bull market, eventually when the market pulls back, as it did earlier in 2025, it implies that it would eventually go on to print a higher high. Thus, in this week's video, we want to take the temperature of the charts, and more importantly, the temperature of market participants, more specifically, the net aggregate opinion of all market participants regarding all subjects on all time frames, and see if we see anything. Do we have cracks emerging that tell us that the next pullback could be something more significant than a 100% normal and to be expected correction? The blue line on your screen is a ratio of consumer staples to the tech sector, XLP in the ETF world relative to XLK. This is the peaking process here early in calendar year 2022. This is the S&P 500 down here. Notice in Q4 of 2021, the ratio starts to move in a defensive manner. As of the close on October 9th, we don't have anything like that. In fact, the chart's printing a new weekly low, and it's down for the week 1.88%. Similar concepts here. This is defensive-oriented XLP relative to growth-oriented SPY or the S&P 500. This is what increasing fear looks like. In fact, the ratio started to rise in June of 2007, several months before the S&P 500 peaked in October of 2007 here. You can see the monthly moving average in blue turns up. The ratio slices through the moving average. And early to mid-October of 2025 over here really doesn't look anything like this concerning setup in 2007 and 2008. This is XLK Tech relative to XLE Energy. This is the secular bull market here. And this ratio started a hiccup after this peak in calendar year 2020. And this is what it looked like. It was falling rapidly when market participants were starting to get concerned about inflation and anticipating the 2022 bear market. Here, we don't have anything like that today. This ratio has been improving for some time. In fact, it's trying to restore a clean, full-bore bullish look. Is blue above red? It is. Is price above red? It is. Has the cloud flipped from red to green? It has. Is price above the cloud? Intra-month and early to mid-October, the answer is yes. Is the green span above price? The answer is yes. That looks significantly different relative to this concerning and deteriorating look in here in Q1 of 2022. This is the S&P 500 lower panel on your screen in Q1 2023. It rallied from this point here in January of 2023 until the recent peak here earlier in 2025. You can see the ratio on the top portion of your screen is XLK Tech relative to SPYG as in George, large cap growth. I might add, XLK and SPYG are both performing well. But you can see when XLK started to outperform SPYG here in Q1 of 2023, it was the early stages of that risk-on period that we just talked about. It's easy to make the argument that this looks similar to this positive turn here in the same ratio in early to mid-October 2025. It's a little bit of a misnomer to say that tech has been killing the S&P 500 and that it's extended in an unnatural manner. In fact, on a relative basis, that's not even remotely close to what's been happening. XLK relative to VU, weekly cloud on your screen, and it's noisy, but easy to understand. This is the ratio here and here. We're just now exceeding the peaks that were made here in 2023 and in 2024. So this is a period of consolidation inside of this region here for tech relative to the S&P 500, and now it's breaking out to the upside. In early to mid-October on the weekly chart, it's outperforming VU by 1.63%, and also now batting 5 for 5 on the weekly cloud. Simply telling us it is possible that we're in the relatively early stages of a trend that could last quite a bit longer. Now let's switch over to the weekly chart of XLK in isolation, up 1.92% for the week. PPO, in this case measuring weekly momentum, it's very, very similar to MACD, did have somewhat of a stall look in here, but it's starting to regain momentum. And it's not unusual after a momentum push like this down here, a momentum push like this down here. In this case, XLK rallied for an additional year. We've all probably read or heard a talking head say earlier this year that tariffs cause inflation. Well, we all know there are numerous potential causes for inflation, and tariffs would be one of many moving parts. This is what XLE relative to SPY looks like when market participants are concerned about inflation, as they were in January of 2022 in the early stages of that 2022 bear market. This is the S&P 500 here. We've referenced this chart numerous times in recent years. And since this peak here in 2022 that for the most part coincided with the low in the S&P 500 down here in October of 2022, this chart has been saying market participants are becoming less and less concerned about inflation being a showstopper. And the look of the chart really doesn't look anything like this move from point A here in November of 2020 to point B here in Q1 of 2022. And if the market's reading this right, it tells us it's possible that the Fed could keep rates lower longer than expected. Or at a minimum, maybe interest rates will stabilize for a time. It's easy to think that the market's been moving in one direction irresponsibly for a long period of time. But the reality is many charts, including this ratio chart, dropped significantly before these moves. It's another ratio chart that for the most part has been moving sideways for almost 5 years. This is VUG, large cap growth stocks relative to VU, the S&P 500. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. As we came back out, retested that same general region, have now gone on the weekly chart to print a higher high. All of this happening as the 200-week moving average was starting to flatten out and maybe even turn up. The longer this breakout holds, the more relevant it becomes. You can see in a risk-off period, this ratio moves from the upper left to the lower right. During a risk-on period, 2020, it moves from the lower left to the upper right. Recently, it's been moving from the lower left to the upper right. Similar situation here. VUG growth relative to IVE value is just now breaking out relative to this high here made way back in 2020 and this high here made late in 2021, early in 2022. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. The ratio is also batting 1,000 in early to mid-October 2025. Is price above red? It is. Is blue above red? It is. Is the green span above price? It is. Is price above the cloud? It is. Has the cloud flipped from red to green? It has. You can pause your video player and compare and contrast the look of the ratio of USMV, minimum volatility, relative to the S&P 500. You can see it breaks out to the upside in a defensive manner in calendar year 2022 during the bear market in the S&P 500 down here. So when market participants are concerned, it's moving from the lower left to the upper right. We've been moving from the upper left to the lower right, and we're still hovering around all-time lows. This is that growth versus value chart that we used when the market was plunging earlier in 2025 and said it was improving and holding up well during that pullback. Well, now it's batting 5 for 5 and trying to print here on the monthly chart another new monthly closing high above this high here from 2022 or late 2021, and this high here that dates all the way back to calendar year 2020. A lot of sideways movement in here, and now we're trying to break to the upside above what is now a green cloud. Remember all the green tables and the bullish signals that we covered a few weeks back? These charts tell us it is possible that the market is going to exceed expectations looking out 1 to 5 years. This is another ratio that's been moving sideways for a very, very long period of time, with this peak here occurring in calendar year 2020. So we're moving sideways in here for about 4.5 years, and then we run up here. What once acted as resistance may act as resistance again up here. But eventually we break to the upside, and we've been holding above this blue box down here for several months now. And the ratio has a full-bore bullish look in early to mid-October, with blue the fastest moving average on top and black the slowest moving average on the bottom. That looks significantly different relative to this bearish mess in here in early 2022. Here's the dot-com bust bear market in the year 2000. This ratio plunges. Here's the financial crisis here in 2007, early 2008. This ratio plunges. The same ratio just broke out of a consolidation box that dates all the way back to the year 2000 and has not been plunging. It's been moving almost straight up in a bullish manner. So thus far, relative to the question that we asked in the opening segment of the video, the charts that we have in hand tell us that the next pullback should be something greater than a 100% normal and to be expected correction. You can determine what the answer is to that question on your own using the chart on your screen. Similar concepts here. Q4 of 2021, market participants start to migrate towards defensive positions, including SPLV or SP low volatility. You can see the ratio of SPLV relative to SPY is moving rapidly in a positive direction here in 2022 as concerns increase. We've been moving in the opposite direction in calendar year 2025 and are hovering around a new 52-week low. All of this occurring below a downward sloping 200-week moving average in red. It's important to keep in mind, none of these charts tell us that the market can't pull back or that a correction isn't coming. But if we trade the chart in front of us, there's nothing particularly concerning on these charts in early to mid-October. As we always say, the only way that we can use these charts effectively is if we take it day by day with no assumptions and trade the chart in front of us. This is the chart in front of us, and it really doesn't look anything like January of 2022. The NASDAQ 100 has been just annihilating the S&P 500. Yes, that's true since this low in 2023, but it's not true when we go all the way back to calendar year 2020 here. It's basically been a toss-up. So this looks like a trend that needed to consolidate its gains, and now it looks like it's trying to break to the upside and resume the secular bull market in tech that began back here in 2013 and 2014. All of the consolidation in here, this is calendar year 2023, all of this seismograph look in here has occurred above a flattish 200-week moving average. And the market made a stand when the tariff news became less bad here earlier in 2025, right at that trend line that dates back to the original trend from this low in calendar year 2013. If you know your stock market history, the S&P 500 peaks in October of 2007 here and doesn't bottom until March of 2009 here. You can see prior to that peak, the ratio of Procter & Gamble, a defensive stock, is already rising relative to the S&P 500. Right now, it's printing a new weekly low or hovering right around a new weekly low. This really doesn't look anything like 2007 and 2008. See the extremely strong trend that was evident in IYW Tech relative to SPY, walking forward from this low here in 2016 until this peak in 2021. And then it ends up that we get a lot of sideways movement. Again, conceptually, this region in here with a lot of sideways movement and volatility can make an argument that this trend or the market needed to consolidate its gains, and it's possible after all of this sideways type movement that we could be getting ready to establish a strong trend again. But that's to be determined. The more important thing is this ratio is back to making a series of higher highs and higher lows, and all of it is occurring above an upward sloping 50-month moving average in blue. Very similar concepts here. You can make an argument that a consolidation period began all the way back in 2020. A lot of sideways movement in here, and now we're trying to break out again to the upside. This is global tech, IXN relative to SPY. Very similar concepts here. IYW, Russell Top 200 growth relative to the S&P 500. Same point in 2020. Exact same point here in 2021. We're back to the same region in 2024, again in 2024, and in 2025. Notice all of this consolidation occurs below the blue lines. All of this consolidation occurs above the blue lines. This is what happened next here, implying the breakout from this W formation says we could still have further to move relative to moving from the lower left to the upper right. And since we're using a lot of weekly and monthly charts, we're not talking about the probabilities over the next 3 sessions, the next 3 weeks, or possibly even the next 3 months. We're talking about the longer term trends, which seem to be attempting to reestablish themselves in a bullish manner. IWF relative to IWD, another way to look at growth versus value. We covered this chart numerous times earlier this year, and it has been extremely helpful. What once acted as resistance, may now act as support, and now we've gone on and we're starting to move away from this long-term period of consolidation in here that began with this peak in calendar year 2020. If you've been around the stock market for a long time, you know, all things being equal, you would prefer the IPO market or initial public offering market to be healthy. That was not the case here in Q1 of 2022. Eventually, you're batting 0 for 5 IPO ETF weekly. Today, almost the polar opposite. We're batting 5 for 5. Now, a lot of these charts that we've been covering, we're saying that the consolidation type boxes started in calendar year 2020. That's not a coincidence, because that's when bond market participants started to become concerned about all of the money printing and all of the mailboxes that were overflowing with stimulus checks. If you look at the chart of IEF 7 to 10 year treasuries, this is the first time since this peak back here in 2020 that a rally has started from above the cloud, and in this case, a green cloud. Said another way, this trend on the weekly chart, IEF, looks a lot healthier today than it has in a long, long time, dating all the way back to 2020. And again, that's relevant because we've referenced 2020 on numerous charts. And why did this ratio move from the upper left to the lower right? The exact same reasons we just cited. Market participants were concerned about the potential for future inflation because the government overstimulated, which was one of numerous factors that played a role in inflation rising in recent years. Same basic concepts here. Notice where the ratio of tech versus energy peaks. Same general area, 2020, and it's just now trying to recapture this gap down right here in January of 2022. If you remember your economic history, we had a terrible CPI print right here, and the market did not like it. You can see we're basically still in the same general region, but now we've gone on after breaking out above that gap. We've gone on now and printed a higher high. It looks like this trend is trying to reestablish itself and move from the lower left to the upper right. At a minimum, all of this since the S&P 500 bottomed here in October of 2022, this all looks a lot better than what was happening between this peak in 2020 and this low in 2022. Similar concepts here. The low that was made on this chart when the tariff news became less bad was basically the same spot where we made this peak in 2021. This low is basically the same spot in 2025 relative to this high in 2020. A lot of sideways movement. It's possible this is going to morph into something more like this, with the emphasis on the word possible. This is what the market looks like when it's concerned about inflation. This is what 2025 looks like in mid to early October. AIQ, Global Artificial Intelligence and Technology relative to SPY monthly. This is telling you it is possible we're in the very early stages of this trend. The blue and red spans are still in the cloud, and price is just now breaking back above the cloud. Keep in mind, that's a monthly chart. It doesn't tell you much about what's going to happen over the next 3 hours or 3 trading days. Similar theme here. 2-year U.S. Treasury bond. Fed has more of an impact on the lower end of the curve. Shorter maturities. This is what the 2-year Treasury yield looked like in Q1 of 2022. It's been much tamer in 2025. Over here, full bore bullish look, batting 1,000, 5 for 5. Today, you've been oscillating between 1 for 5 and 0 for 5 in calendar year 2025. Dot-com bust bear market, tight cluster with the weekly moving averages rolling over, bad things happen. Early in 2008, similar and concerning tight rollover look in the early stages before this plunge. Tight and concerning, tight and concerning. Present day is tight and encouraging. This looks a lot more like this and this and this relative to this or this. This is the peak in the year 2000. This is the peak in calendar year 2007. Dot-com bust bear market, financial crisis bear market, October of 2025. We all know it's extremely important to take it day by day and trade the chart in front of us. In early to mid-October, the daily cloud, which isn't particularly relevant to our longer-term time frame, is also batting 5 for 5. And at the moment, it has a nice, sustainable trend look, trending above a green cloud. Day by day, trading the chart in front of us, understanding that the only way all of this can be useful is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.